So you guys got the training videos.
Yeah.
I'd like to see the memos. So if you can give me those memos, I've been asking for them. Just give them to me. So deliverable 2 on Monday, cover memos, midterm, give me the country reports for everybody, not just the team, because I want to see all of them. The emerging stock market fact sheets. Again, pick 2 emerging markets and do the fact sheet again. Indonesia, Malaysia, Singapore, Chile, one of the emerging markets. And then the homework 2, I actually did a video on the homeworks, except for 17, which I already did in class. Before that, and then give me your resume. Okay, I want to see the updated resume. And then deliverable 3, again, cover clip, the memos, global stock market fact sheets, the bond market fact sheets. What I'll do is I'll do like a 2 or 3 page, quite like I did for the exam, for the Lufthansa, how do you say it? Lufthansa case study, so you can fill it out while I'm doing the lecture. And you can put that in there too. And then the peer-reviewed journal article. Has anybody picked one yet? No? So I'll find some. And then homework 3 and 4, there'll only be maybe a few problems. And then, do you want to do Deutsche Bank or do you want to do HSBC?
Deutsche.
You want to do Deutsche? Okay, we'll do Deutsche. And then resubmit the GTC report with it. Because I want to be able to take those packages and pull a few of them and give them to like the chair and the Larissa, Zahn. I want to give them so that they know what we're doing, in the class. So the schedule next week, I'll do chapter 18 again. You guys did a really great job. Congratulations. And then KJE is going to do the multinational cash management on Wednesday. JJC is going to do international trade finance. And the following week, Monday the 8th, MSM is going to do transfer pricing. And then we'll do 2 days of Deutsche. We'll pound that out, go through the training program, again, go through evaluation methods. And then you guys will do your presentations on Monday the 15th in Deutsche. And then you'll do presentations on your global stock and bond fact sheets. I want to hear about them. And then you're going to, on the last day, on Friday the 19th, you're going to give me your GTC economic pitches. Okay, so just the economic portion of that. And then the peer-reviewed journal article, you're going to give me an update on that, just a quick, what was the article, what was it about, what was the problem, hypotheses or questions, what was the data, what was the model, the methodology, and then what was the conclusion, and what's your GTC recommendation to exploit and commercialize the R&D from the peer group. And that's it.
Do we make a PowerPoint for that too?
For which one?
For the peer journal presentation?
No, just one page.
Okay, so we're just going to get up and just say it really quick.
Yeah, we're just going to talk about it real quick. And again, just one page.
Do you want us to dress up on the day, or?
No, you don't have to. And then on the final exam, we'll do. On the final exam, we'll do a course review. We'll do like the mini exit lecture with a focus on foreign and global. And then you're invited to meet me at the Cooperage, and I'll buy you a burger and some beer. Because some of you are graduating, and I'll never see you again. All right, is that going to work? Yeah, it is. It's a restaurant in
Buying it out?
Lafayette.
You getting rowdy in there?
No.
Bring the Coke and the hooker seat.
And then I would park in the Safeway parking lot and walk over. If you run out of time, they'll totally ticket you, and then you'll be out $20.
Actually, I think
What?
should all get a big Uber.
All right, so let's go through some of these questions really quick, and then what I'll do is I'll come around and I'll check this stuff, because I want to make sure everybody's on the right one.
The test is due today.
You know, everything's due on, so I'm giving you some extra time. And I'll be around this weekend too, so if you want to call me or text me or ask me any questions, more than that, I'll be available. Okay.
Cool.
All right. So chapter 11, international banking and money markets. You assume the settlement rate is, hold on a second, just give me 5-10 minutes. Okay. You assume the settlement rate is 6 1/8. It's a $3 million FRA. It's going to start in 3 months and it's going to end 6 months later. The agreement rate is 5.5%. So the 3 month, it's a 3 month dollar loan, which is the asset, 6 month euro dollar deposit, which is the liability. And again, what they want to do is cure the mismatch between the assets and the liabilities. And the question is, how much is the FRA worth, and then who pays? So since the settlement rate is greater than the agreement rate, then the seller pays the buyer the value of the FRA. So to calculate the value of the FRA, you take the notional value of $3 million. The the 6 1/8% minus the 5.5%, so it's basically the agreement rate minus the settlement rate, times 92 divided by 360, which is the time period, divided by 1 plus the agreement rate, times 92 divided by 360, which is going to give you the 4,417.16 cents. The next one is another FRA. It's 3 against 9. The agreement rate is 4.75%. You're gonna forecast a 6 month LIBOR in 3 months from now to be 5.125%, and you're taking a speculative position in 1 million notional value. So 183 days in the FRA period. So the question is, should we buy or sell the FRA, and what's the expected profit? So the million is the notional value. You got the settlement rate of 0.05125 minus the agreement rate, 183 divided by 360 divided by 1 plus the settlement rate times 183 divided by 360. So the value is, for the FRA, is 1,857.61 cents. So you would buy it. International bond market, you're considering a 8.5% Swiss franc US dollar dual currency bond, paying $666.67 at maturity. The Swiss franc is at $1,000 par, and it's currently selling at par. So the question is, what's the impact on the Swiss franc dollar exchange rate at maturity? And would the investor be better off at maturity if the Swiss franc to dollar exchange rate was 1.35 Swiss franc to the dollar? So the dual currency bonds call for an exchange rate of a Swiss franc of 1,000 at face value that you're going to buy for $666.67. So the implicit exchange rate built into the dual currency bond issue is for the Swiss franc to be 1.5 to the dollar. And then at maturity, it's going to be 1.35 to the dollar. So basically, the dual currency bond investor is worse off with the $666.67 because the dollar is depreciated over time. So you can see if they're going to be getting this at maturity, they should be getting $740 instead of $666. They're getting $666 because of the depreciation of the dollar. So the investor is worse off because of the depreciation of the dollar and appreciation in the Swiss franc. The third one is a 5-year 4% euro yen bond at par. The comparable risk on other bonds, 5 years is 5.5%. Yen dollar dual currency bond that pays $833.33 at maturity, and it sells for 110,000 yens. So the question is, what is the implied yen to dollar exchange rate at maturity? So the solution is, since the dual currency bond is a comparable risk and it yields 4%, like a straight euro yen bond selling at par, you can just calculate what the exchange rate is. So you already know what it's selling for. You can calculate the coupon on it, and then you use the present value interest factor of an annuity for 5 years at 4% to get the value. You're looking for the exchange rate for the yen to dollar. You know what the par is going to be, or what it's going to pay at maturity, and then you discount that back at the present value interest factor for 5 years at 4%. And then you just get the numbers and you solve basically for the exchange rate. The exchange rate here, the dollar amount is going to be $124.85 or 86 cents. So you can back into the exchange. And then on the currency swap, in Chapter 13, the corporation enters into a 5-year interest rate swap with the swap bank, agrees to pay the swap bank fixed 9.75% annual. The notional amount is 15 million euros. The corporation is going to receive LIBOR. So as of the second reset date, you need to determine the price of the swap from the corporation's viewpoint and assume the fixed rate now just went up to 10.25%. So on the reset date, you need to calculate the present value, future floating rate payments the corporation will receive from the swap bank based on the notional value. So the present value of the 15 million bonds issued with 3 payments remaining at 9.75% coupon rates, now at 10.25%, is $14,814,320. So the swap bank is willing to buy from the corporation, or the corporation is going to sell the swap based on the difference between the two, so for 185,696 euros. So obviously, if the interest rate goes up, the present value of the bond, the swap contract goes down. And then the last one is Chapter 15, which is pretty straightforward. You just calculate the weighted average expected return on the portfolio based on the monthly, and then you calculate the variance, and then the square root of the standard deviation. And then you can divide the return by the standard deviation to get the return to risk ratio. And you can do that for 3 different portfolios and then compare the 3. If all 3 are at the same hurdle rate, but one gives you less risk, then you're going to buy the one with the highest risk-adjusted rate of return. Okay? You can turn that on.